Hello everyone, welcome back to this last lecture of week 5 for our course Metrics and Analytics of Marketing. In this week we have basically discussed about customers profit, customers lifetime value, and then we went beyond customers lifetime value to define a metric called prospect lifetime value. In the last class we had a detailed discussion about this matrix, how we can take business related decision based on the value of this metric. We defined a formula for prospect lifetime value, then we looked into the sensitivity of prospect lifetime value. For example, how a small change in prospect lifetime value can make a higher extent of differences in terms of business value that can be derived by the business. In today's class, what we will try to look into is what is behind the formula of prospect lifetime value. What are the business decisions that can be taken by prospect lifetime value. So, this particular class will be a detailed discussions regarding prospect lifetime value and customers lifetime value. We will also look into how an equivalence can be established in various contexts regarding prospect lifetime value and customers lifetime value. They can be considered as the same metric, but their unit of analysis are different, but in various contexts both these metrics are important. So, let us dive more into this session where we will start to look beyond the formula of prospect lifetime value. So, what we basically try to do here is we want to get the PLV metric ready for decisions, right. So, let's just have a quick recap of what was the formula for prospect lifetime value. So, the basic formula was acquisition rate multiplied by number of prospect multiplied by CLV plus the initial value minus your acquisition cost. So, that was the basic formula of prospect lifetime value. Basically, if we have a detailed look at the metric, it has 4 inputs. One is the conversion rate, which is also called acquisition rate, then the initial margin plus customers lifetime value minus the acquisition spent. So, we are already aware about this, the definitions of these 4 metrics. So, what we can do, if we can make some changes in terms of some intervention in those 4 input variables, then we can improve on the prospect lifetime value. And we have in the last class we have already seen the sensitivity of prospect lifetime value. A small increase in prospect lifetime value will result in a higher extent of additional value for the business. That is why we need to keep these 4 input variables monitored while we proceed with the business. Acquisition spend is nothing but how much you need to spend in a campaign, right. So, divided by the number of person that is acquired or number of prospect that has been derived from this spend. Conversion rate is like the percentage of people who have been converted from prospect to customers. Then initial margin is like at the first instance, at the first transaction, how much of the value a acquired customers create for the business. And customers lifetime value is nothing but the present value of the future value that is expected to be created by a customer. Though prospect lifetime value is a important and critical matrix, it is prone to multiple challenges. The first trap associated with prospect lifetime value is the very definition of customer lifetime value. customer lifetime value can be defined in various contexts. It is okay to define it differently in various contexts, but the thing is that we always need to analyze it consistently, otherwise the results will be wrong. So, in our case we have defined the customer's lifetime value as the present value of future transactions that will be made by the customers, right. So, but whenever we are defining the total value from a customer, we are always adding another term which we are terming as the initial value, right. So, if we define it combining initial value or excluding initial value, that is okay as long as our analysis stay consistent, right. Then next one is, if we only consider the present value of the future transactions by the customers, we also need to take into account the cost associated with the first period. What is the amount that is incurred in maintaining their relationship for the first instance? So, that we cannot ignore, otherwise our calculation will be wrong. The third challenge associated with prospect lifetime value is the attribution bias. All of we know that there is a lagging period between when a particular marketing campaign is initiated and executed and when its results start coming. Let us say I execute a marketing campaign today, people will become aware about the product, people will become aware about the brand, and then they will develop some interest, then it will go to consideration stage and it will go to purchase stage. So, now all these stages take some amount of time depending on the market condition, depending on the product context. So, this lag period is not fixed, and that is why it is always, it is difficult for us to exactly identify which particular result is coming from which particular campaign. Now, attributing the cost or attributing the benefits to the campaign becomes a challenge. So, that is why it can create a lot of attribution bias. But with the help of models, with the help of some models which will identify and correctly assume what should be the lagging period, we can try to solve the problem, right. Then there is another challenge or another ambiguous aspect, that is campaign interaction. One acquisition effort can undercut the another. So, there is a possibility that multiple campaigns are being run by the brand at the same time. Let us say one campaign is run in the digital space and another campaign is run in the physical space. There is a fair possibility that same customer will encounter both the campaigns. At least a portion of your customer or prospect will encounter both the campaigns, and after looking into the campaign, they will develop some interest and go to the next stages of the marketing funnel. But they become interested about the product because it has some value. Now, it becomes extremely difficult for me to determine which campaign should be given the credibility, whether the customer has been acquired from the digital campaign or the customer has been acquired from the physical campaign. So, this becomes a challenging task. Now, if this is the scenario, then in that case what will happen? It will be extremely difficult for us to calculate the acquisition cost or the lifetime value. So, these challenges needs to be addressed before we actually fine tune the matrix. Now, another one aspect is that extend to the cost metric, acquisition versus retention cost and how to read them. What is the acquisition cost? What is the retention cost? The bifurcation itself is challenging, right. So, whether the customer is staying with your organization just because of the initial encounter with the advertisement where he established an emotional connectivity, or because of the retention initiative that your brand is taking and getting the customer engaged with the brand. So, these are difficult or critical aspects, but you need to fix it. You need to fix the accountability, you need to fix the credibility of each penny of expenditure with each of this outcome, right. Now, let us, because we have already said that customer lifetime value is defined as the present value of the future transactions. Initial margin is ignored when it comes to customers lifetime value. In some of, some of the practitioners might consider it along, but they should be consistent in their analysis. That is perfectly fine. So, now why initial margin is separate from the CLV? Because of the definition itself. How did we define the customer lifetime value in one of our previous session? That it covers the future cash flows only, and that is why we will just, whatever the future cash flow is coming, we will just discount it as per the discount rate and then calculate it, consider it as the customer's lifetime value. Initial cash flow is not included as far as the definition is concerned. So, that is why what we need to do is, we need to add it to the customer's lifetime value whenever we are talking about the total value that can be derived from a customer. At the same time, we need to take into consideration that initial margin must include any first period retention spending. There is a possibility that in the first transaction itself or before the first transaction, there can be a customer related cost associated. So, that cost has to be taken care by the initial value itself. Probably what we can do, what is the amount of value created in the initial transaction minus what are the cost associated in the initial transaction. So, if this attribution can be done, we can easily calculate and analyze the cost benefit. Now, let us have a look at the detailed challenges associated with prospect lifetime value. As we said that prospect lifetime value is a determinant of 4 variables: acquisition rate, then acquisition cost, then your customer lifetime value and initial value or initial margin. So, any challenge associated with each of these 4 variables will be a challenge for prospect lifetime value. So, first challenge and biggest challenge comes in the form of calculation of customer lifetime value. This is the hardest input to estimate because it requires forecasting customer behavior over time. We already mentioned that whenever we are talking something about human behavior, customer behavior is nothing but human behavior. It is extremely difficult for anyone to estimate. If we look at the research, like research which includes the human behavior aspect, so most of the research will give you a lesser amount of variation explained by the independent variables. R square value, that R square means how much of the variation of the dependent variable is explained by the set of independent variable, is always lesser when it comes to human context. It is not like an E equal to MC square equation. It is like we are determining behavioral intention by attitude or subjective norms, right. So, that is why it is extremely difficult, and this challenge is further made complicated when it comes to this dynamic business environment, dynamic market conditions. You know how market conditions are changing, how rapidly it is changing over a period of time. With the emergence of, let us say, artificial intelligence, with the volatility in the geopolitics and throughout the globe. So, market conditions are changing to a higher extent. Now, within that market conditions, if you have to predict the customers behavior, that too for the future, let us say not just for the next year, let us say that it is for the next 10 years, then I mean your prediction may go wrong. That is why it is a challenge. Customer lifetime value calculation is not a easy task. On the other hand, if we look at the other PLV inputs, they are relatively easier to estimate. Campaign cost, it is with me, how much expenditure I have incurred in initiating and executing that particular campaign. So, that is with me. Then conversion rate. So, after the only challenge here will be the attribution. So, if I can somehow get rid of the attribution, then in that case it is much easier to calculate the conversion rate. Similarly, for initial margin, I know what are the associated costs, I know what value is being derived, then I can easily calculate the initial margin. Only problem or challenge that here is the attribution, right. So, CLV depends on long run drivers. We have already seen CLV is a function of your retention rate, CLV is a function of your discount rate. Retention rate is dependent on human behavior and discount rate is up to a higher extent, it is dependent on the market conditions, right. So, some of the drivers of CLV are retention, repeat purchase, margin stability and discount rate. So, I am just reiterating the definition that the formula that we deduced last to last class. So, what was that? How did we calculate the customer lifetime value? Customer lifetime value equal to margin multiplied by retention rate divided by 1 plus discount rate minus retention rate, right. So, if the retention rate is higher, then in that case customer's lifetime value will be higher. If the discount rate is higher, customer lifetime value will be lower. Fine. So, we have already discussed the impact of the numerator and denominator. Now, let us also look at the sensitivity of customer's lifetime value, the inputs associated with customer's lifetime value. For example, if there is a small error in the retention or in the margin, it can swing the PLV from positive to negative, small increase or decrease, right. You can just internalize the same thing just from the formula. PLV equal to acquisition rate multiplied by initial margin plus CLV minus acquisition cost. So, anything if there is a change in retention, that it will impact the customer's lifetime value to a higher extent, and that is why it will also impact the prospect lifetime value to a higher extent. So, each of these metrics are interlinked to each other. Only thing that you need to consider is the sensitivity. Whenever you are, because you will be taking the decisions under certain assumptions, you need to make sure that your assumptions are logical, your assumptions are as per the current market conditions, as per the reality. Otherwise, you will do the analysis with a right approach, but the results that you are getting will be wrong. So, it will lead in a bad decisions, probably you will lose a lot of money, right. So, these challenges are always there in place, but you have to navigate through these challenges. One way of navigating through these challenges is, rather than keeping the values constant throughout the lifespan of the customer with the brand, we need to keep updating these values as per the market conditions, as per the evolving needs and expectations of the customer. So, now let us have a look at the different CLV conventions. So, firms often define the CLV differently depending on the decision context, that we have already mentioned. Somebody might be calculating the CLV including the initial value, somebody might be calculating the CLV or defining the CLV excluding the initial value. So, both the ways are perfectly okay as long as your analysis is consistent. Differences usually come from what is included inside the CLV term. So, for example, in our case, in our classes we have defined the CLV as the future cash flows only, which is called as strict CLV. Then we can expand this definition of CLV, which we have already termed as total value, or expanded CLV, which is the summation of initial margin plus future cash flows. Then we can also what we can do is that whenever we are doing a proper and complete cost benefit analysis, we are taking the value into consideration, we are taking the cost into consideration, total value minus total cost, that it becomes a net CLV. So, I can do my analysis in terms of net CLV also, that is also perfectly fine. So, all these approaches can give the same economic conclusion if used consistently. Consistency is the key here. If you are not consistent in your analysis, probably the results will be wrong. So, now let us have a look at two different methods. One is CLV including the initial margin, and another approach is calculation per prospect. So, first thing in this method A, which includes where the CLV includes the initial margin, what we have to do? First step that we have to do is that combine the first period economics with the lifetime economics. What is our lifetime economics? It is the CLV, which is calculated by the function of discount rate and retention and margin, right. Now, then we can easily calculate this initial margin, which is like initial value minus initial cost. So, this will give us, let us say, a CLV apostrophe, which is the total value by a customer for a brand. Now, in calculating this PLV, what we can do after we have calculated this one CLV including the initial margin, we can calculate the PLV using the same structure. Now, what will be the PLV? Acquisition rate multiplied by CLV apostrophe, which is the total value, minus the acquisition spending, right. So, benefit of defining it this way is that it keeps the PLV formula simple. It is the same as we defined in the previous class, but it keeps it simpler while ensuring that initial value is not forgotten, neither ignored. Now, in method B, what we will do? We will do a calculation of per acquired customer. We will calculate the value in terms of per acquired customers. So, we are just moving ourselves from prospect level to acquired customer level. We will not look into the acquisition rate, rather we will look into the number of acquired customers and what is the net value of these acquired customers. So, whenever we will be calculating the net value of these acquired customers, then we will be back calculating the cost associated with the process of acquisition. So, it more or less remains the same, only thing is that unit and level of analysis are different. So, what we have to do in this method is that first thing we have to calculate the net value from the acquired customers. So, what is the net value from the acquired customer? Net CLV equal to customer's lifetime value minus customer acquisition cost, right. So, we have already taken the cost associated with the prospecting in case of through customer acquisition cost. So, how we will calculate the total value? That is NCLV, right, net customer value multiplied by number of acquired customers. So, benefit associated with this method is that total value is derived, right. So, in both the aspect has its own advantages and disadvantages, but it will remain consistent. Only thing is that you have to understand which unit or level of analysis you are using, right. So, let us quickly do this equivalent check of both these methods. The same campaign can be valued in two consistent ways, both these ways are same. Let us say if we are doing a per prospect calculation. So, what we have to do? We have to calculate the prospect lifetime value as per the formula, right? And then what is the number of prospects? Normally the number of prospects are always high, and that's why we said that prospect lifetime value is a very sensitive matrix. Any change, any smaller change in prospect lifetime value will lead to a higher change in the overall value for the business. Then in the second method, per acquired customer, net value per acquired customers multiplied by number of new customers. In this case, we are not considering the aspect of prospect, we are only considering the acquired customer. So, what is the average value that is being brought by an average acquired customers? So, that value will be higher because average value, because number of acquired customers will be much lower as compared to number of prospect. But cost associated with acquired customers will also be higher because we are attributing the cost to the acquired customers, not to all the prospects, right. So, this match because they are just the different units of analysis, they are just calculated at different levels, either at the prospect level or at the customer level. Otherwise, the chronology of the analysis remains the same. So, what you can do, you can use whichever format fits your audience, but keep the definition consistent throughout the deck. Only key point that you have to take forward is that consistency in your definition, consistency in your analysis. Now, we will look into some of the metrics which are related to acquisition and retention cost, right. So, by this time we have already understood that these profitability and customer lifetime value related metrics are important because it gives a holistic view of where does our brand stand financially. So, let's start with the first matrix, which is average acquisition cost. So, this is nothing but acquisition spending divided by number of customers acquired. In our previous classes example, if you remember correctly, that we took the example of that total spending was $60,000 and total number of readers were 75,000. So, acquisition cost we calculated as 60,000 divided by 75,000, which gives us a value of 0.8. So, the same formula was used in our previous instance. Then coming to average retention cost, it is the retention spending divided by number of customers retained for the next phase or for the next period, right. So, retention spending can come from customer relationship, expenditure in customer relationship, then expenditure in let us say extending some offers to the customer. So, all these things will come under retention spending, and number of customers retained is determined by your retention rate. So, basically whenever we talk about this critical metrics such as average acquisition cost or average retention cost, these metrics are some of the monitoring metrics, and basically they indicate the efficiency of your business operations, marketing initiatives, and they may not be a complete profitability metrics, but they are indicator of your effectiveness of your marketing campaigns. So, best practice for you is to compute them by segment or channel, not only overall average. The main advantage when you compute them by segment or by channel, you will be able to understand which expenditure is worth it and which expenditure is probably not wise to continue. Let us say we are spending in digital space, we are also spending in physical space. But if we do not calculate them separately, there is a possibility that whatever we are spending in physical space, we are not getting any result from there. We have most of the results can be derived only from the digital campaign. Similarly, across various segments. So, if we do segment wise analysis, then we will be able to understand which segment is giving us benefits. Segmentation may be value based segmentation, segmentation may be demographic segmentation, segmentation may be geographic segmentation, as we have discussed earlier, right. So, only thing that these metrics needs to be monitored continuously. So, I would like to conclude this class with a sentence: disciplined acquisition is the foundation of sustainable growth. Before spending something on acquisition initiative, you need to calculate what is the PLV, whether the PLV is positive. If the PLV is positive, it is time for you to go with the campaign, otherwise not. And even if the PLV is this one, what could be the estimated total value for the business, that needs to be kept in mind, right. So, thank you. I will see you in the next class.